Shaheen, I'm going to start with you. We were both at COP. I think obviously there has been a lot of COP talk already today, but I think a lot of us in this room probably know there wasn't as much probably that we wanted to see come out of COP, but what would you say were kind of the most significant pieces that did come?
Sure, thanks, Meg. So first, I think, this was my first COP. I don't know about you, but I've never seen anything like it in terms of just scale and size. The biggest takeaway, I think, was this excitement about the loss and damage fund to start with. So I think this came on the agenda for the first time, the fact that, more developed countries could set aside a fund to basically fund less developed countries in terms of mitigation and adaptation. The frustration, as you mentioned, was around emission reductions, right? The fact that we didn't really build upon what we saw last year at Glasgow. And that was the major frustration. All the reports around, temperature and warming, I think was fresh in everyone's mind. So there was this real angst that I could sense on the ground. I think on the ground, though, more nuanced discussions were around, one, carbon markets. I felt like that was the most polarized topic. You had one set of people who thought it was quite a legitimate transition, solution. And then a whole other set just thought it was the devil. And there was no in between. It was just this completely polarized topic. And then the second one was around carbon reduction goals. So I think everyone recognized that companies are setting carbon reduction goals at a pace we've never seen. But we need plans, we need actual sort of implementation, we need more information so that it's not just paper decarbonization. So those were sort of the two takeaways and more sort of on the ground nuanced conversations I had at least.
Yeah, interesting. And Trina, then to you, so obviously going to the targets and the carbon reduction targets that we've been talking about, in absence of some of the action maybe we were hoping to see, what are business and finance now kind of doing to pick up the slack on those issues?
I think a lot of the time when we maybe are let down by global policymakers or someone gets elected into office and doesn't necessarily have a climate agenda, we've seen the focus turn to the private sector. And I think this is no exception. We've built up quite a lot of momentum in the private sector during the last presidential administration when there was less going on at the national level. And a lot of that momentum is just continuing to build. We've seen coalitions of private sector actors build around these issues. The RE100, that's a coalition of private sector companies that are aligning to 100% clean electricity. The Science-Based Targets Initiative, so companies declining their emissions alongside the Paris Agreement. We're seeing on the financial side last year, the GFANZ, the Glasgow Financial Alliance for Net Zero. It's 500 plus financial institutions aligned with net zero emissions by 2050. And so none of these are going away. And in fact, the pressure on these coalitions is really stepping up. There's pressure from multiple angles. There's stakeholder pressure, so investors actually engaging with companies on these issues. The Climate Action 100, which is a group of massive investors working with some of the heaviest emitting companies to both disclose their emissions, disclose their climate risk, and also start to take progress towards those targets. We're not going to see this pressure go away. This is what customers want. This is what we were just hearing earlier from Impossible Foods. Customers want this, individual investors want this, asset managers are going to start to see the pressure coming down the line from younger generation investors in particular. Just last week, the Stanford Business School put out a survey saying that 80% of millennials and Gen Z investors want their asset managers, their money managers, to engage with companies on climate. So we're not going to see this go away.
I think one of the things I've heard so far today is, obviously we've had all of these target setting has been a big thing and everybody's been making net zero, but now wanting to move, okay, how do we move to implementation? I think we heard Selwyn Hart say that, how do we take that next step? So what is it that companies and investors can do now to kind of move from that to that implementation phase in 2023?
Yeah, that's right. And Shaheen was also just mentioning this on the national level. And so we're starting to get into what my colleague the other day referred to as the era of interim targets. And so what I mean by that is a lot of companies set these goals in the last 5 or 6 years with 2025 seeming far away. And so a lot of companies, when they set a 2050 goal, they'll also set an interim target to keep them on track for maybe the early 2020s out through 2030. And those interim targets are coming up and we're starting to notice this. So I mentioned the RE100. There's actually been a couple of companies that have already missed their interim target for 2022, and right now it's showing up in kind of a footnote in their sustainability report. But investors are going to catch on to this. We at BNEF are going to be tracking this. We're going to be putting out research on this, and companies are increasingly going to see their stakeholders say, "You set this target. Where's the actual progress toward it? Where's your clean energy procurement? Where are your carbon offset retirements, et cetera?"
Shaheen, anything you wanted to add to that as well?
I would just agree with that. I think you mentioned the interim targets. So that's actually something that came out of COP also. It was this document on sort of if a company has a target, sort of what are the outlines that it should have. And one of those were interim targets. So I just want to sort of reinforce that. And I feel like we are seeing a little bit of progress towards implementation. Another thing that came, I think, while we were at COP is the UK regulators proposed a new, well, it was a law, I think, but it was basically around the fact that if you have a goal, you have a plan to meet that goal. And I think that's where we want to go.
And what do you see typically that is included in a successful plan to get to that implementation?
It really comes down to the solutions that the company is implementing to meet those goals. So it's about capital expenditure, it's about basically what investments are you taking to meet those goals. And what I find really useful is some kind of financial analysis over that. So is it NPV positive? In what situation does it have a positive rate of return? In what situation does it not? Like, I'll give you an example of a steel company, but they have one of the most ambitious goals, but it's only IRR or rate of return positive if steel prices stay high. Now, what are the chances of that? Who knows? So assumptions, financial returns, plans, all of the above.
Yeah, and forward-looking.
Forward-looking.
Yeah. So let's turn to the climate bill. As you mentioned, we did have an era where there wasn't a lot of climate action on the policy front in the US. Now we have a big plan. So why don't we start with you, Trina? What do you kind of see as we're moving into 2023? Like, what impact is that going to have on climate action for us?
Yeah, absolutely. I think we can all celebrate that this was really the first huge climate success in the US. And at BNEF, a lot of our different teams across content coverage have been looking at how this will impact, electric vehicles, solar, wind, et cetera, on a really detailed level. But at BNEF, I focus on sustainable finance. And from financials, we often hear, we would love to transition our portfolio, we would love to be invested in more clean energy, but there's just simply not enough projects. And I think what we're going to start seeing in the next couple of years with renewable costs declining thanks to the IRA, we're going to start to see many more opportunities and developers really stepping up, and that's going to help financials also get really invested in this space. So I think we're going to start to see that really accelerate. A team at BNEF, some of my colleagues just put out a report a few weeks ago on sort of the investment needs that we need in the energy sector, specifically out to 2050 to meet our goals. So basically what they did is took different net zero scenarios through 2050 and averaged what the investment need across fossil fuels versus clean energy would be. And sort of took that ratio of total global investment, both public and private finance, in clean energy to fossil fuels. And what they found is this decade, out through 2030, we need a 4-to-1 ratio of clean energy investment to fossil fuel. That ratio right now is about 1-to-1. So we need that to quadruple by the end of this decade. And what I think we're going to see with the IRA is financials really stepping up.
Shaheen, what are your thoughts on what we're going to see in 2023 because of that?
Sure. So I'll take a slightly different angle and talk about fund flows for clean energy. So I think this is really interesting. The one thing we note is that last year, fund flows to clean energy spiked. It was about 10x any other year. So it was about 10 billion last year versus about 800 million the previous year. Now, billion versus million for clean energy ETFs. And what we think is when President Biden came in, basically everyone anticipated more favorable climate policy. So they sort of priced it in. They drove clean energy prices in terms of share performance up, fund flow went in. And when the IRA came out this year, we didn't see that market reaction, which normally we do see clean energy very policy reactive, right? But we didn't see that. And a lot of that is because we sort of, I think, priced it in. So while the IRA is positive in terms of the fundamentals for clean energy, it's positive for maybe long-term fund flows. In 2023, I don't expect this, spike again from policy reaction.
Interesting.
We already saw it, yeah.
Okay, interesting. Okay. All right, great. So then what are some of the, just talking a little bit more about fund flow and playing off of that, what are some of the emerging trends you're seeing right now around ESG performance and fund flow?
Sure, so ESG performance, I think everyone knows has not been that great this year. ESG funds tend to be underweight energy, and energy has been great, so it's not done well. Just as a fun statistic, so this year, about 20% of ESG ETFs in the US beat their benchmark versus 60% in 2020. So steep drop off.
Wow.
Yeah, I think in terms of fund flows, there are really 4 things. Well, I'm watching like 20 things, but there are 4 things that I'll mention. The first one is just overall trend. So fund flows for ESG, and I look at ETFs in particular, have skyrocketed, right? They've been exponential till about last year. We've slowed down this year. But what's interesting is the slowdown is almost entirely driven by the US, and Europe has sort of chugged along. In 3Q, actually, 90% of ESG ETF flows globally were from Europe, and I've never seen that before, 90%.
Wow.
The second piece is that investors are moving towards the most sustainable funds. So if you think about European regulation, right, Articles 6, 8, and 9 is how funds have to categorize themselves. So Article 6 is no ESG, 8 is promoting ESG, and 9 is sort of ESG focus. It's the most sustainable. So in 3Q, 50% of flows just went to Article 9. So it's very clear that given greenwashing risks and all the risks out there, investors are moving towards the most sustainable. The third one is around climate ETFs. So we've all been talking about climate. We've all been hearing about it. And we actually see, in terms of new fund launches, climate has far outpaced anything we've seen with ESG, anything I've seen in its history. So just as an example, last year, about 180 climate ETFs were launched versus 30 in any previous year, so 6x, wow. Right? Now, this is great. It creates, breadth of flows. It creates breadth of strategies and many options. But there's also a huge risk. What I see really is oversupply. I see slowing flows, so you see slowing demand, and that's really a recipe for disaster. That's a recipe for liquidation for your strategies that cannot compete. These funds are also expensive, and that's not good. And the last one would be around concentration risk with ESG. For the last few years, we've all celebrated when ESG has grown, but nobody's really realized that that growth was a handful of investors. So just as an example, last year again, 22% of ESG fund flows went to 10 funds. There are 1,400 funds. So that's not really sustainable, yeah. Right? It's a good thing because your institutional investors who have large chunks of allocations drive it forward, but we need a more sustainable investor base to sustain this. Otherwise, they're going to exhaust their allocations and it's going to taper off. So those are the 4 trends. It's concentration risk, climate ETFs, and liquidations. It's sort of the more sustainable category that we're leaning towards, and it's Europe chugging along while the US is calming down.
Interesting. So then what do you think that means, looking at those trends? Like, what are you kind of expecting 2023 is going to hold for all of those flows?
Yeah, so I think, going to the first point, Europe is going to continue ahead because it's clearly got the regulation. It's clearly got the drive for this.
Right.
You have, for example, MiFID suitability regulations where the new regulation says you have to ask an investor whether ESG is suitable for them, and I think that can really drive flows rather than just being ignorant and not knowing.
Right.
So Europe can continue the trend. I do expect some climate ETF liquidations next year, the non-competitive strategies. I think in terms of flows, we could see a lot of cyclicality, right? I mean, huge chunks of money come in, flows go here, that one flow will go out, people will cry. It's the cyclicality in flows that I think we're just going to see for the rest of the year.
Yeah. Katrina, anything you want to add to that on that one?
I would just say a lot of the backlash that we've seen against ESG this year Some of it has come from the right. Some of it is sort of equating ESG with quote unquote woke capitalism. We've seen some critiques and having this be politicized from politicians on the right. And on the left, we've also seen a lot of pressure saying all of this is marketing, all of this is just greenwashing and misleading claims. And what I hope that we'll see in 2023 is that some of this backlash will lead to some clarity around what ESG actually means. Is it just holding tech stocks in your portfolio that underperformed this year? Or is it actually investing in what we call the transition? So actually investing in technologies that we think will help us reach net zero. So I'm hoping that this provides a lot of clarity in 2023 and starts to become a little bit less politicized, because at the end of the day, a lot of this is about opportunity, and it's also about managing risk. So it's really just making sure that fund managers are taking a look at all of the risks posed to the companies in their portfolio, and a huge one is climate.
All right, data, something that we all talk about all the time, and the lack of kind of standardization of data. You know, one of the things, Shaheen, I know that you look at a lot is the fact that there's a lot of historical data, but what about forward-looking data? And you kind of reference that a little bit too. So how do we start to move to a place where we have data that really helps with what we're talking about a bit more, and more to a less historical and more forward-looking?
So first, the importance of forward-looking data. The biggest complaint I've gotten is, Shaheen, all this ESG data, it's historic. Investment analysis is forward-looking, and we need to get that, right? ESG needs to be more forward-looking. The easiest way to fill that gap is by analyzing targets and goals, right? Not so much where a company is, but what is your target? So that's the first point. We've started to see that. Actually, we've seen it quite a lot for climate. So companies are setting carbon reduction goals. But I would love to see that beyond it for more material issues that companies are facing. You know, say a cement company, yes, carbon is material, so I want to see a carbon reduction goal. For a miner, I probably want to see a water reduction goal. For a food company, maybe a sustainable sourcing goal. So it's sort of merging goals with materiality. If you ask me, that's my dream data set. It's like my wish list. So that's the first thing. The second example of maybe a more forward-looking metric is looking at which companies link their executive compensation to ESG issues, right? Linking money to something is a very clear driver. I mean, if my annual bonus depends on it, I'm going to do it. Yeah. So that's another way to see which companies can really drive change into the future. It's part of my presentation later today.
Yeah. Yes. She will be giving a larger presentation, so stick around. That is an interesting thing. I think that's a new trend that we haven't heard before, which is this linking of compensation. How is that happening? A lot. Is that happening a lot, or is it? What's kind of the percentage of companies that are actually? 27%
of the Russell 1000 have some sort of ESG linkages to the executive compensation, much more than we've seen in the past.
Yes. Okay.
Much more.
That's great. That's very encouraging. Anything on the data front that you would like to see more of in 2023 as you're watching on the BNEF side?
Yeah, well, I think we're going to see a lot more of climate data, and maybe this actually brings us to some of the SEC regulations. So here in the US, we've been kind of a bit behind when it comes to sustainability data regulations specifically. But in this past year, we've started to see regulators really step up in line with the EU. And through the two SEC proposals, I think we're going to start to see a lot more data, both from the corporate side and also from the investor side. So relevant to public companies in the US, all public companies will start to have to report their carbon emissions data and also their exposure to climate risk under the SEC proposal. And investors, on the other hand, will start to have to clarify exactly what the labels on their ESG funds mean, and what's sort of going into their assessment of corporate climate risk as well. And so I think we're going to see a wealth of data coming out of companies in the next couple of years. Of course, many of you might have seen that there's some pushback against the SEC proposal, and I think we'll start to see maybe a couple of lawsuits, maybe some hearings in Congress calling the SEC chair to testify about how this is actually material risk to companies. But I think that overall, there might be some delays, but we're going to start to see a lot more climate data coming out of companies.
Interesting. So, and regulation, another thing that everybody is watching in this space this year. What are the trends you're seeing globally on regulation? And to your point, to Trina's point, is the U.S. kind of lagging behind? And
So Trina mentioned the fund regulation. That's the main thing I'm watching. So now, given greenwashing risks, a lot of countries are requiring funds to basically categorize and label themselves. So we have that in the US, the UK, and also Europe. What I think is the most interesting is the European regulation. So again, they have to categorize themselves as 6, 8, and 9, 6 being no ESG. And what that's really enticed, I think, is a little bit of dilution. So it's created this name and shame approach. Funds don't want being named and shamed for being Article 6. So they include these ESG light criteria and just rebrand into Article 8. And I've seen that in a huge way. So there are about 64 rebrands last year versus a maximum of 2 in previous years. And that's all European funds driven by SFDR regulation. That's the main thing. I think the second piece is around disclosure. I think Trina's already mentioned it, so I won't go into it, but it's around sort of the climate rules, at least in the US here. And we think that could be watered down a little bit just because, the House being Republican, I know the SEC is sort of an executive branch, but it does fund the SEC, so it could just underfund it. And then the last part in the US at least is around sort of antitrust regulation and antitrust laws. And there's this warning that if ESG is considered, colluding against certain industries, it could create antitrust issues. Now, while we don't think it actually violates any kind of competition laws, it is a theme that we're watching a little more globally.
Interesting. All right, a couple of questions from the audience. Sustainable ETFs are still a very small piece of the overall market. Do you think existing small ETFs grow in AUM? Do you see continued proliferation, or could the sliver generally shrink in 2023? And out of 1/3 of connected to MSCI, do you expect another index or marker that could be adopted?
Okay, so I'll address that first part, and then I might ask you to repeat the latter.
Yeah.
So sustainable ETFs are about, in the US they're tiny, it's about 4% of global ETFs. In Europe it's much bigger. I think we're closing in on about 15 to 20%, which is not bad. Again, all driven by SFDR regulations and rebranding. Now, in terms of fund launches, what I do think is fund launches is going to slow. We are seeing a bit of a slowdown. And a lot of that is because, a lot of asset managers already have strategies in place, so they don't feel the need to launch more. I think in terms of fund flows, like I said, we're going to see that cyclicality. And what we really need is a wider investor base to be able to invest in these funds. These fund launches have been prolific. What fund managers are doing is they're sort of going into the more nuanced categories. ESG is pretty competitive, it's pretty established, so they're starting to basically find themes that are different to differentiate themselves. Like you have the Veterans Fund that came out a few years back, you have the E&I funds that came out, and people seem to latch on to themes that are coming out to just differentiate themselves. That's the theme I see going on.
Okay.
And I didn't catch the last part.
That's right. The second part of the question was, do you expect another index or marker that could be adopted?
Index or marker, as in, I don't.
So the full question was, and out of 1/3 of the ETFs are connected to MSCI, do you expect another index or marker that could be adopted?
MSCI is about 75% of the ESG ETF world. I think one of the trends we've been seeing is a lot of the data providers being acquired, right? So Morningstar acquired somebody, then S&P acquired RobecoSAM, I think, and that led to them launching their own indices. So these acquisition of scoring companies by data providers and index providers leads to more competition. We saw the S&P 500 ESG ETF because S&P acquired RobecoSAM and could do that. So I see a lot of sort of prolific index providers launching new strategies to maybe compete with the MSCI or add to it, only because they've acquired rating agencies. Yeah. MSCI is still 75%.
Yeah, okay.